I've been meaning to finish this video for a little while now. You can see on the slide here, from empty classrooms in week 1 to a couple of people, the end of week 1, and now we're back to full classes. So what I'm going to finish here is I'm finishing accounting terminology and the accounting cycle. So let's get going. I have mentioned before, goods, stock, inventory. What we're talking about in business is the stock that we are selling, and this terminology here, 3 different words which mean the same thing. We're looking at a trading concern, and we are buying goods in order to sell, to make a profit. So goods, the physical items that we buy and sell. Stock, the items that we buy and sell. Inventory, collection of goods, the goods that we buy and sell. So I'm showing you the different words used for trading inventory. Trading inventory is the best word, but different textbooks talk about goods, stock, inventory, and there's another word, merchandise. It's all the same thing, what we buy in order to sell, to make a profit. What we buy and sell means trade. We buy goods, stock, inventory in order to sell. For example, Calibre Education sells digital products, videos, and the best word, trading inventory. Inventory is the collection of goods a business owns and intends to sell. So items that are ready for sale and those still being produced. Right, that's an important point there. Items that are being produced can add to the value of your stock. You get semi-finished products, that's also part of your stock, but we're not really looking at manufacturing concerns at this particular point in time. We're looking at buying and selling, and you're a sole trader. And remember, we always look at the books from the point of view of the business. So Calibre Education is selling digital products. Right, what is a service? A service is a case where you're not selling a product. So this is another way of earning income, but you offer a service. And a very good example would be the hairdresser. The hairdresser doesn't sell a product, but cuts your hair. It's a service. Extra lessons online. You don't sell a textbook, you sell a lesson online. Now, a hairdresser can actually sell shampoos and products for your hair, but the main nature of the business is to cut hair, to offer a service. Other service concerns, we're looking at doctors, lawyers, accountants, lawnmower services. They offer a service, but they can also sell physical products, but the nature of their business is to render a service. Service is a way of earning income for a business. What is a journal? Now, a journal is used to record the transactions that take place in the business. Any financial event that has an effect on the accounting equation is a transaction, and all the transactions are first recorded on source documents and then entered into a journal. You get lots of different subsidiary journals, and like transactions appear in specific journals. What I mean by that is, we got the petty cash journal here. So any small payments made used by petty cash will go into a specific journal, in this case the petty cash journal. For example, to buy postage and stationery, staff refreshments, maybe pay a small telephone bill, the owner takes drawings. Those are examples of money being used from the petty cash. and therefore the journal used is the petty cash journal. And what a journal does is it summarizes like transactions, similar transactions, before this information gets taken to the general ledger accounts. In accounting, that's called posted to the ledger. There it says posted to the ledger. So it first goes through a journal, the transaction. I just put in the cash there because all these transactions, they're taking cash from the petty cash and they're making small purchases. Right, what are subsidiary journals? The petty cash journal is an example of a subsidiary journal, but you get quite a few different journals. Here's a debtors journal. A debtors journal records credit sales, which results in debtors. In this case here, Calibre Education sold to the school quite a few times on credit because the school has an account with Calibre Education. The debtors journal is an example of a subsidiary journal. So is the petty cash journal. Subsidiary means falls under the general ledger, so or before the general ledger. So all transactions are recorded in subsidiary journals before the information is posted to the general ledger. And these are the types of journals that you get. What has happened, I think, with software is sometimes information won't be recorded in all these journals, but it'll go straight to the ledger accounts, and they might just run with a general journal. But we're doing all the journals, and we will see what source documents are used to record transactions in these journals. So there we go, to cash book receipts. Any transaction that affects the bank balance of the business positively will go through the cash book receipts. Any transaction that affects the bank balance negatively will go through the cash book payments. Debtors journal or sales journal is there to record credit sales. Debtors allowances, returns by debtors. Creditors journal, all items purchased on credit. Creditors allowance, all the returns our business makes to suppliers. General journal for transactions that don't fit into any other journal. You do get certain transactions that are recorded in the general journal, maybe settlement, discount. We'll go through a few eventually. Right, petty cash journal. We did discuss that previously, but that's a journal that records all the transactions where petty cash was used. So those are all the subsidiary journals we will be looking at. This is an example of a general journal. It's laid out slightly different to the other journals. We will see in the future, because the details column will have information relating to the general ledger accounts, which accounts are debited and which accounts are credited, and they have a debit column and a credit column. It's laid out differently to the other journals. Right, what does liquid mean? Liquid in accounting means that basically the current assets are greater than the current liabilities of the business. That would find your business in a liquid state. It means that you are able to cover your short-term obligations. You are liquid. You have enough cash, or items that are close to cash if they're sold. For example, trading inventory. All the value of your current assets is greater than the value of your current liabilities. For example, creditors. You are able to pay your suppliers on time. Your situation is said to be liquid. So if your business is going into liquidation, consistently you're unable to meet your short-term obligations because you don't actually have enough cash. Yep, you heard that saying, cash is king. You need to have access to cash or credit. And amazingly enough, that's something that was said by Luca Pacioli in 1494. You need access to cash or credit, and you need a good system to record your books. It's not a secret. And that is, let's say, your tips to having a successful business. You need cash. If you can't buy stock, you got nothing to sell. If you don't have a good accounting system, you won't keep good records of your business. If you don't have cash, are you able to borrow money, right? Those are three things necessary to run a successful business. Right, and there we're just pointing out once again, your current assets have to be greater than your current liabilities, and then your business is said to be in a liquid state. Right, what does solvent mean? Solvent means the total assets are greater than the total liabilities. And that means we're talking about short-term and long-term. For example, total assets will be non-current assets, like a vehicle, the business building, the business equipment, plus the current assets, cash. It's greater than what we owe the bank and what we owe our creditors, our suppliers. Then the business is solvent. So if you go bankrupt or insolvent, that means your total liabilities are greater than the value of your total assets. So there's a difference between liquidation and solvency. If you go into liquidation, your current liabilities are greater than your current assets. If you go insolvent, you take the whole value of all your assets, including things like your car and the building, and you cannot pay back your loan from the bank or your creditors, then you're insolvent. That's a pretty bad situation. You're going to end with nothing. Right, so total asset value is greater than total liabilities. That means you are solvent. Right, what is selling price or sales price? It is the price at which you sell your product to your customer. That is the selling price. So the selling price of an online video, 149, 175, 210 in our example. Those are just videos there. Right, so that's the sale of digital products in our Calibu education business. That is the selling price, and I've just written there including VAT. We do VAT at a later stage, or you can watch my VAT videos on this channel. Right, so selling price is what we sell to the customer at, and the selling price will include a markup. Right, source documents. Now when a transaction takes place, by accounting law, everything needs to be documented. So if, for example, Calibu education returned goods, in fact, yeah, what happened was the school returned goods to Calibu education, and Calibu education sent a credit note saying that we're going to credit their account. We agreed to their claim for goods that did not comply with the order. But more about documents in the future. All you need to know, source documents record a transaction when it took place. For example, invoice, receipt, bank statement. In this case here, the transaction would have been written up with the duplicate, because the original would have been issued to the customer. Right, there's another example of an invoice. This is an invoice from the computer store to Calibu Education to record the fact that Calibu Education bought tablets for students and software to the value of 75,050 Rand. This must be paid back within 30 days to the computer store, because that's the agreement we have with the computer store. So once again, a source document records a transaction when it took place. It needs to be documented. In this case here, the computer store sent the original to Calibu Education. And Calibu Education, we keep in the books for Calibu Education. We take this document and we record this transaction in the creditors journal, purchasers journal. That's the journal for credit purchases. So we will look at all the source documents involved in transactions. Source documents record transactions that have taken place. What is a transaction? I like this definition. A transaction is any financial event that changes the accounting equation. Because what makes up the accounting equation? Assets, owner's equity, liabilities. So if there's an effect on the accounting equation, a transaction has taken place. For example, Richard made a capital contribution. Calibu Education made a cash purchase, credit purchase, credit sales, insurance, petty cash, paid a creditor, bank charges. Those are all examples of transactions, and all transactions will have an effect on the accounting equation. A equals O plus L, and we will see what effect these transactions have on the accounting equation very soon. So we all know what a transaction is now. And what is a trial balance? A trial balance is a summary of all the general ledger accounts, and it will be all the general ledger accounts will be summarized in a trial balance, and you will have a debit and a credit column. And the best way for you to understand this is to see one. So a trial balance is done at the end of each month, and you're going to have two sections to a trial balance. A statement of financial position. In there you got all your balance sheet or statement of financial position accounts. So those are owner's equity, assets, liabilities, examples of balance sheet accounts. There's a debit column and a credit column. According to accounting rules, these accounts will end up either with a debit or a credit balance. Very soon we will be doing the accounting rules, and you will understand why an account ends up with a debit or a credit balance. But this here is trial balance, and it's the first part of the trial balance: owners accounts, assets accounts, and liabilities. It's a summary of all the general ledger accounts, and it is a checking mechanism. You can check if your debits equal your credits, and if your debits equal your credits, it doesn't mean that you've recorded everything accurately, because you could have debited the wrong account, you could have credited the wrong account, you could have left out transactions, but it's an indication that what you've done does balance. It's good if it balances, but it's not necessarily correct. The second part of the trial balance is the nominal account section. I couldn't fit both these sections in one slide, so this is part of the balance sheet section. Underneath there's the nominal accounts section, and here you're going to have all your income and expense accounts, and everything that has happened to date in the current financial year. And you can work out from here quickly if you've made a profit or a loss, because you've got income minus expenses, and we will learn why these balances are either credited or debited when we do the accounting rules. So this is the nominal account section. This here is the accounting cycle, what is done on a monthly and a yearly basis. We will be looking at the dark gray area, transactions, right? Transactions are recorded on source documents. These source documents are used to record the information in those subsidiary journals, all these subsidiary journals. From the journals, the information is taken to the general ledger, posted to the general ledger. There's also a debtors ledger and a creditors ledger, accounts receivable and accounts payable. And at the end of the month, reconciliations are done, for example, a bank reconciliation. Now, in order to reconcile what is on the bank statement, the balance on the bank statement, and what is in our books, in our bank account, we need to find the differences. It's highly unlikely on the last day of the month that the balance on the bank statement that we get is the same as the balance in our books because of, for example, a timing difference. Let's say, for example, we made an entry on the 30th of January and we deposited money into the bank account, into our bank account. The bank might take a few days to process that and for it to reflect on the document, the bank statement that we get from our bank. That's an example of a timing difference, and you will see we will do a bank reconciliation statement at a later stage to get the two numbers to equal. That's a bank reconciliation in a nutshell. Right, also at the end of the month, we draw up a trial balance. A pre-adjusted trial balance is something that's drawn up after 12 months at the end of the financial year. Then these blocks here, we will do in semester 2. So at the moment, we're looking at the dark gray blocks with the white writing. That is the accounting cycle, bookkeeping cycle, monthly and yearly. For you, transactions take place, they're recorded on source documents. They are then recorded in journals. The journals, the information is taken to the general ledger, the ledger. Then a trial balance is drawn up. That's what you need to know. I just put this in. This is where we're going. But this year, I've put in a statement of profit or loss and other comprehensive income. That's an income statement, which is drawn up at the end of the financial year. In here, we've got income and expenses, and it'll tell whether you made a profit or loss for the year. That's an income statement. And we have a statement of financial position. There we go. In here, amazing. We're going to do this very soon. Assets equals owner's equity plus liabilities. That is our accounting equation. And our next section, we're going to look at how transactions affect the accounting equation. Then eventually, at the end of the year, we're going to draw up a statement of financial position. That is called a balance sheet. And in here, it's going to be assets, owner's equity, and liabilities. Right, we might have a little bit of a laugh. I hope you're going to enjoy this video and all the other videos that are coming. Chat soon. Keep up the great work. Cheers.